Hi there. So I guess we're going to have to go through this. I probably have too many slides. We'll go really quick, and I hope you absorb it all because there's a lot of important information here. So to start out with, I think I'll just tell you what I'm hitting. I'm hitting the basic high-frequency trading strategy that's been dominant in U.S. equities since an inflection point starting in early or late 2006, early 2007. Then I'm going to explain how HFT in U.S. equities and Regulation NMS are intimately intertwined. I'm going to explain some of the properties of HFT-oriented special order types that give HFTs an advantage over institutions. I'm going to hit on some of the landmines that you can encounter within exchange order matching engines. And then I'm going to give a forecast on, at least from my perspective, what's going to happen over the course of 2013, because most of the things I'm discussing here are huge topics in the industry and are also undergoing significant regulatory scrutiny. So scalping strategies. The primary features, and you need to understand these features generally so you can understand how the order types, Reg NMS, and everything else plays into them. There's a connection between the features of this class of algorithmic trading strategy and what the exchanges have done in terms of evolution of market structure. The basic property is high frequency turnover. This, in the early 2000s, if you told me that I could get in and out of a trade in 10 seconds and I could get 5% of a name, I would think you're crazy. But that's the goal of this type of strategy. Probably the fundamental property that I think most of the quantitative trading firms outside of HFT missed is the critical importance of Q position within your strategy itself. And I'm going to explain that probably a little bit more detail in a couple slides here. Of course, most low latency, high frequency oriented strategies are going to have precise and timely reaction to market microstructure events. We also have this class of strategy, especially maybe 2004, 2005, starts leveraging special order types and order matching engine features. So you start seeing innovation in the mid-2000s that gets more and more complex, and many of those features were basically evolved to accommodate the needs of high-frequency traders, specific firms, in fact. This type of strategy compresses quite quickly, so the subsidy of rebate is kind of critical to this class of strategy. And we have post-only orders which control the rebate costs and make sure you aren't exposed to taker fees. And then the last thing I think is very important to understand is that these firms in this class of strategy consider high-frequency turnover and exiting risk is basically an insurance against adverse selection and toxic order flow. So the idea is that they can't forecast what's going to happen in the future, and U.S. lit markets are quite toxic. They're going to rapidly try to get out of all inventory. And that's, you hear these firms that will trade 10% of the market and they're flat end of day. And, that's connected to that concept. It's a very important concept because when you have half of the U.S. market have extremely low risk tolerance, you get derivative effects in the market itself, such as the mini flash crash. I'll explain how that happens. Next, here, these are just some general bullet points on the strategy. You require price-time priority market structure to exploit the Q position. So these guys have to be fast because they're just trying to get to the top of the order book. What's important to understand is that there only are certain moments in time when you can get to the top of the order book, which is why speed matters and precision matters. These strategies are not joining a bidder offer and slowly rising up the queue. They're trying to set the market and get to the top first, and that can only be done. It's certain precise. Now it's repeatedly microseconds. So low latency is key for superior queue position. you get 5 or 6 firms in the market that have this class of algorithm, it compresses quite rapidly down to an effective zero-width market. And what does that mean in practice? It means you buy at the bid. You are not trying to scalp out for a penny. You're trying to exit at that bid price. And that's, you kind of think of that as your best case scenario. And that would make a lot of sense if you think about the exhaust flow and the institutional order flow that's constantly hitting the US market and trying to access liquidity. So this is basically a flip out strategy. And if you go look through the data, especially after you learn about some of these concepts, you can easily see in tick data pretty much everything I'm talking about here. But you kind of need a framework to understand why it's happening, and that's what I'm trying to explain. So let's talk about Q position. This is completely naive, dumb explanation, but I think it's compelling. Let's say I have a naive strategy. I have no view of the future. I'm in a market with that's basically normal distribution events with no it's completely neutral random order flow. If I get to the top of the queue, and HFTs care mostly about a one-tick winner or loser. The view of what's going to happen beyond that is less important than the concept that if I make a penny, or if I get a one-tick winner, mark to market, I can get out and I can lock in a profit. So that's kind of the key idea. Is the whole space of the future compresses into uptick, downtick. If I'm at the top of the queue, I'm likely to trade most of my one-tick winners. It's, if I'm top of the queue, it's unlikely that the next tick is going to clear out, let's say I'm on the bid, going to clear out the entire offer and move away from me. So I'm going to get to trade a significant portion of my one-tick winners if I'm top of queue. Let's say I'm resting there. Keep in mind, I'm also going to trade all of my one-tick losers, right? This is random. This is nothing about information, right? I'm resting, market goes against me, I trade everything. Market goes, the other way, I trade some of the good trades. Okay, that's, kind of an explanation on why spread and rebate subsidy are so important. Because a naive joining algorithm has an expected loss in let's say, a very, very small tick size. Rebate and tick size will basically make a naive strategy profitable. However, this would only work if there's only one firm doing it. So I'll explain later in the presentation what happens, how does this work when there's 6 firms, and I'll explain later. But the other situation, and think about a program trading desk that's passively, or electronic trading desk is what we're calling them now, passively joining bids or offers. They're at the back of the queue. What's going to happen? They're unlikely to trade, especially in a name like BAC, where they're way at the bottom, with 70,000 shares ahead of them. They're unlikely to trade any one-tick winners, and they trade all one-tick losers. So if you're at the bottom of queue, you hemorrhage, you bleed to death very quickly. Okay? The other thing, which I will now I've explained that it's all about shifting the distribution of trade events. When that toxic trade comes in that's going to sweep against me, there's another concept embedded in this, is to try to detect when that's happening and to cancel. You hear everything about HFTs canceling all the time. Cancellation is extremely important. There's just an opportunity cost. If I get out of the way, I can afford to cancel, 20, 30 times to get out of that way of that big landmine coming in. I have my, a lot of false positives, so a lot of false alerts, but I can get out of the way, and it only costs me market share. So there's an emphasis on avoiding negative alpha, and by avoiding, that's kind of a market-making mindset. If I avoid that toxic flow coming in, my distribution is going to bias towards a net positive mean in terms of my P&L. So this concept of sweep risk, where a large order, and that's you guys maybe, comes in and takes out the whole price point. That is the bane of this strategy. That's what that strategy will lose money on that trade if it trades against it. What is going to happen? usually is when a sweep is detected, you try to cancel as it's sweeping the market. Let's say I'm on one market, I get hit there, I get off the other market. That's why you see that rapid withdrawal liquidity. And what I'm going to try to do is either hit some dummy behind me. Let's say I traded. I'm going to hit the dummy behind me. And think about an inverted market like, what is it, Edge A, right? I can hit a dummy behind me who's posting on Edge A, exit that bad trade, which I got rebate for, and actually make a net profit on my bad trades if I manage sweep risk correctly. But what that does, since everybody does it in the HFT space, the top 5, 6 firms are all responding to the exact conditions, and they're responding to each other. I'll give you a very clear thing. If someone's at the top of the queue, and that's the fast guy, and he's always at the top of the queue, and he cancels, well, they can see that over the price feed, and they're like, whoa, I'm going to get out of the way. Something's coming in. So there's this concept of looking at the electronic crowd and trying to forecast that a sweep risk is coming in. Run away. And that if there are no other algorithmic trading traditions in size in that name, that will cause a cascade effect. And that's, in some cases, you'll get the mini flash crash when there's basically no algorithmic strategy in there that can correct, prices that are arbitrageable from, let's say a statistical standpoint. So if there isn't a stat arb that's diving in there to trade that bad price, you're going to get mini crashes when 6 or 7 participants, immediately flip out of the market. As I said, go back, look at your tick data in BAC. You'll see this is how the name trades. So let's talk about Regulation NMS. It was formulated in 2005, established in 2007. A series of initiatives designed to modernize and strengthen the national market system for equity securities. The term HFT was not widely used until Reg NMS came out, and specific firms had enormous change in their profitability. For me, everyone's like, well, what's HFT? To me, HFT in U.S. equities is simply a class of strategy run by around 10 firms that no one heard of prior to 2007, and everybody, and they were basically the market leaders after 2007. If you were making a lot of money in the early 2000s, and there are some, firms out there that have high-frequency trading desks, it's not the same type of high-frequency trading that is dominating U.S. equity volumes right now. So the important thing to understand is the adoption of Reg NMS coincides with a period of intense HFT volume growth. Okay, well, think about what's going on as Reg NMS is being negotiated and rolled out from 2005 to 2007. HFTs are starting to get more volume. They got some special order types. They're making $20 million net a year. The banks are still ignoring them because that's not an interesting enough number, right? But this legislation's coming, or this regulation's coming in, and it's going to change the whole game. Every single, aspect of price movement, what is permissible, what is not permissible, what trades can happen, and also the moments in time when I can get to the top of the queue and in what my impact might be of canceling orders. All of that is affected by Reg NMS. The whole game changes. So this is kind of a crisis point for HFT. And certain individuals and firms were very involved in trying to assert or proactively argue for certain features within Reg NMS. As you can see, these are the bullet points: getting to the top, canceling ahead of sweeps, who's the maker, who's the taker, what signals can I get over the price feed to detect adverse fills, and the whole aspect of what speed advantages, where does speed help me and where does it not, and what microstructure conditions. All of it is impacted by Reg NMS. I'm going to give you 2 very specific examples. Okay, Rule 610 of Reg NMS banned lock markets. A trading center must prohibit its members from engaging in a pattern or practice of displaying quotations that lock or cross any protected quotation in an NMS stock. What does that mean? If there's a 2-tick wide market, I could jump in the middle and be the best bid or offer, but I will likely lock have my price be the same price as an opposing bidder offer on an away market. Well, that's impermissible according to Reg NMS. It was a critical constraint. That one piece there, Rule 610, completely changes the top of queue game. So it's a critical constraint impacting top of queue strategies. Now, what are exchanges doing in that situation? They are actively changing your price and rebooking you, and I'll talk about that later. They're not allowed to accept your order into a lock. So in other words, the legislation says you're not allowed to send that order and get to the top of the queue in precisely the conditions where an HFT would want to do that, right? So just remember, the basic default behavior of these exchanges is to not let you post that aggressive price. They will change your price on you. And some exchanges, which I think is kind of comical, will actually require that you call up the help desk and ask for a port setting change so that your confirmations coming back actually indicate that your price was changed. So you can't even look at your fills and know whether or not, or sorry, your confirmations and know whether or not your order was adjusted to comply with Rule 610, unless you call up this particular exchange and have them like change some database code. So this, a lot of people will look at the data and say, it looks okay to me. I'm like, well, that's actually not correct data, right? You need to know exactly, every single exchange in the US has some variant of these practices. So if you're not on top of the specific features in each one, then your order is basically being treated to some kind of default behavior. And I would argue that some exchanges, the default is tolerable, and in others, it's completely egregious what happens to your order. And that's one of the reasons I became a market reform advocate. Rule 611 mandated trade-through protections. A trading center must prevent trade-throughs of protected quotations in NMS stock. Well, that also creates an important constraint. It tells you what prices are allowed to trade or not. What does that mean in practice? I don't know. For IOCs that are marketable in fast market conditions, 30, 40% in certain names might be rejected. You're not getting rejected because the liquidity wasn't there. You're getting rejected because you violated Rule 611. You just have to look at the code on your reject, and you realize you were trying to hit that order. It was there. You missed it because of Rule 611. Well, guess what happens? If there is a slow SIP speed, think that's the regulatory feed. Think what NYSE just got fined for. If there's just one exchange that is slow and pumping bad data to that SIP, what's going to happen is you're not going to be able to trade prices that should be tradable, right? And you're going to get immense adverse selection. Well, guess what? Modern HFT has gotten around all of these inconveniences of Reg NMS, right? So that's the story, is that Reg NMS completely screwed up the game, and they found clever ways, and the exchanges created innovations to basically circumvent the entire regulatory framework in all of the areas that impacted HFT needs. All right, so what happens after 2007? Well, the exchanges go on a complete innovation binge. They create a number of special order types. The press says 2,000. No, there's like 15 order types that matter. The 2,000 order types, the way I think of it is that's the forest. You have to know what trees, you're going after to basically, protect yourself or take advantage of the features I'm explaining. There's also order modifiers, really, quite interesting fields that you can set on your orders that basically dictate very precise order handling treatment during locked markets, for example. And then lastly, new port settings. That means you have to call up the exchange and know that there's a database code that if I set it this way, I get to get treated the way an HFT would prefer. Again, all this stuff is not the default order handling of orders in the U.S. equity markets. So what I'm arguing here, and here's the truth. The truth is, without these features, HFT goes back to 2005, 2006, and looks like a curiosity again, right? These are the features that supercharge this entire industry. The secret sauce of HFT often amounts to to little more than the application of these innovations in their intended usage scenarios. So that's my beef, right? It's very, very clear, once you're an insider, what the purpose and intent and intended usage scenarios are of these features. They are all connected to precise microsecond events, right? The order type, if you just use it randomly, doesn't do anything for you. You have to actually use it in the moments that matter. And that is not properly disclosed by exchanges. But over the last 18 months, there has been significant change because the fact that these features were not disclosed adequately and the usage scenarios of those features is something regulators have been looking at for 18 months now. Okay, special order types. Let's talk about some. There's actually a ton, but we're going to talk about just some of the cases here that might be more, actually just easy to understand is probably the best reason I'm picking these. Okay, on locked and cross markets, exchanges employ a number of price sliding behaviors to comply with the prohibition against locked markets. So first you got to understand price sliding, as I hinted at it earlier. Price sliding is an exchange is allowed to change, they would argue that you made the decision because you used that order type which has that price sliding treatment. Or just, no matter how you look at it, the exchange is adjusting your price based on logic that they're running and shifting your order around in the order book. Rebooking you, basically. That's what price sliding is. And they're doing that when the price is moving. When you are locking away market, when there's a moment where you could get it to the top of the queue. Basically, in the most advantaged situations where you could get an edge over the market, that's when the exchange is changing your price. And through this process of rebooking, they're also changing the time you execute, right? So the way one exchange explained it is that they have the flexibility in the sensible and convenient booking of orders. So they're doing you a favor. Their other choice is to kick your order back. Well, guess what? That's an HFT mode. Don't handle my order like that. Kick me back. You can actually choose that as a port setting on one exchange. Okay? So that's how it's described in documentation on one exchange. The thing to realize about price sliding is it occurs in this two-tick market condition that I explained, which is, and what I say here is, note that all exchanges, according to Reg NMS, in theory, must display a two-tick or greater gap before a one-tick price move in NBBO is permissible. So people ask me, they're like, how frequent is this? I'm like, this is how every price tick in the US equity markets operate. This is the mechanics, the quantum mechanics of price movement. This is happening for, that is why HFT-oriented scalping methods that use these features are, my estimate is true HFT, probably, and I don't even know now because it's been on the wane, but at the peak I'm thinking like 40% is my personal estimate of what that volume was. But that volume is coming in to these two-tick wide markets, exploiting order matching engine practices like price sliding and special order types to achieve, certain goals, such as a superior queue position. So the point here at the bottom is that HFTs are not waiting for that two-tick wide market across every exchange. They're not waiting for those 13 exchanges to fade before they place their bets. All of the special order types are in a class related to Rule 610 are all oriented to placing your bets before the price move changes. Okay, so price sliding is a key element in exchange order handling that governs what we call lighting a new NBBO price. Okay, that's the moment in time a new price is permitted to change the regulatory NBBO. Price sliding impacts that significantly. It also determines which orders are placed in favorable or unfavorable queue positions. It determines when and what price orders are booked at, and it thus defines eligibility for maker rebates and taker fees. That's a thing I think is still lost on people, is that these practices are intimately connected to who gets the rebate, and I think people generally understand that the HFTs are trying to get that rebate, and there is a reason for that. Okay, so I'll probably make I want to make one more point there. The conditions which HFTs are targeting to make rebates are also favorable trades. They don't want to get a rebate and then have a one-tick loser. So there's actually a positive alpha in those conditions. It's not just about the fee. It's about doing the right trade. So price sliding effectively picks losers, winners and losers in the context of HFT scalping strategies. You could argue all day, well, I did this at this price, and then the price 5 minutes later, it wasn't really a winner under that 5-minute mark. I'm explaining here, it's all about whether or not you could have gotten a better price in that very short interval. And I would argue if you use HFT-oriented features, you will get a better price. So again, I want to harp on this. For 5 years, I had to listen to this whole narrative about everything being fast. My story is I was led to believe it was a speed issue, and I spent about a year building out 6 colos and forcing my team to get faster and faster and faster. What I didn't realize is by not leveraging the special order type features and knowing about what I would argue are undocumented price sliding practices, by not knowing that, I ended up jumping into these bad, disadvantaged situations more frequently. So, that's, basically in this dark pool is the story of me hunting for this bug. Well, I was basically building a system that would jump into what I argue is order matching engine abuses. And I was becoming the first dummy to get in there and bleed. I was ahead of everyone. So it's kind of, a quite paradoxical experience. You're like, I'm getting faster and faster and faster. I'm like, this thing is hemorrhaging now. And there was one moment in time where my partner was just yelling at me. He's like, how can you lose, we're trying to do like 15,000 shares in SPY. How can you lose 2 pennies in SPY? It's a penny wide. Price sliding. And Q jumping, and these features that have come up in the Wall Street Journal and I'm explaining now. But that's what was happening, and the story is I finally was introduced to the features by one exchange who then, as I went through the process, I learned that basically all exchanges had in some manner had to address these issues to attract HFT order flow. So the last thing is speed matters, but don't put your money into speed. It matters only if you know what order type to send and when to send it, because low latency trading only matters to the degree traders act upon the same events. If you're not competing against someone else, if they're not pulling, if they're not pulling your quote while you're trying to hit them, or you're 2 guys trying to go for the same Q position, you've got 200 milliseconds to make that trade. You don't need any speed investment at all. But so you need to conjoin speed with HFT-oriented knowledge, period. So let's talk about 2 of them. Well, hide and light orders, which there wasn't really a name, so I just picked that out of a hat and started using it. There are various names on the different exchanges. They basically circumvent the adverse impact of the ban on lock markets using clever regulatory workarounds. So another way to say it is HFTs hated price sliding. They wanted a way to get into the center and lock markets, and that's what these order types do. They're kind of have your cake and eat it too order types, because they exploit a regulatory kind of workaround where they get to be a hidden order when that's convenient, and they get to be what's called a protected quotation when that's convenient. They're like a hybrid order. So those orders are quite useful. And there's also Rule 611. Rule 611 actually permitted a type of order called an ISO, which was meant for large traders to sweep across the order book. Well, what happens is you can leverage the exemptions of ISOs, and you can use fast price feeds to basically place orders that in trade-it prices that you can justify. You're like, I knew the NBBO better than the regulatory feed. I'm ahead of everybody. So you can use this low latency speed advantage to actually trade at prices that the public customer is trying to trade at and getting rejected. Okay, so those are 2 key classes. There are also a lot of other interesting things that happen. Some of them are market maker orders that can discriminate effectively. I don't actually have much of a problem with those. But there's also midpoint orders. Some midpoint orders are oriented towards institutions. Others are oriented towards HFTs. You have to know which ones are the HFT ones on which exchanges. So these two order types, what do? They provide a shortcut to the top of the queue, and they avoid price sliding. Not all price sliding is bad. Just certain types of price sliding that HFTs would consider bad, these order types tend to avoid. Okay, one exchange explained the purpose of the orders was it eliminates the need for traders to retray orders multiple times in rapid succession, trying to be high in priority at the next MBBO price. Doesn't that sound like HFT scalping? So when you read in the press that these order types were generally available for everyone and they weren't catering a specific class of participant, well, most electronic trading desks at banks are not trying to rapidly retry orders multiple times in rapid succession, trying to be high in priority at the next MBBO price. So these are HFT-oriented orders, and I will just maintain that till the end. With the orders that hide or light, orders that lock the MBO are hidden instead of rejected or price slid. And see these orders at the bottom? Those are actually your limit orders, right? I get some criticism. It's not what you might expect. HFTs say to me, offline, I have email chains when I came public on this, that, they would never use regular order types. Are you crazy? Right? These, of course you have to use these. So I love it. Like HFT is all for like a very long time. We're like, that's the bread and butter order types of the U.S. market. You show this list to another crowd, they're like, what is that? It's Greek. Okay? So let's talk about order matching engine practices. The complex sequence of microstructure events tied to price moves dictate HFT profitability. So, as I learned at Trading Machines, exchange order handling is now a primary factor impacting execution, performance, and slippage. We went, there was a group at my firm that that was trying to address the slippage problem by forecasting the market. Certain liens, and what you could get out of that was nothing compared to what you could get out of using the order types correctly. So HFT-oriented special order types avoid and in fact benefit from disadvantages that frequently impact traditional order types. So I only have 5 minutes here, so I'm going to only do two more slides. But I'm going to explain again the dark side of Reg NMS price sliding. Orders can be disadvantaged by being kicked to the back of the queue. Orders can be promoted to the front of the queue. Maker-taker fee allocation can be attributed in an opaque and unusual manner. Certain innovations that were introduced, I'm thinking about one in July 2011, creates unexpected collisions between sophisticated participants and unsophisticated participants that otherwise would not have occurred. The impact of price sliding on order type precedents is not properly disclosed by exchanges. Okay, I'm going to give you an example of queue jumping here. I've shown, when I show this slide to any, to like an institutional crowd that are doing large orders, they're just like, oh my God, they get it. Okay, so we're going to show how an institution improperly accesses, one exchange here. Assume the market for XYZ says 2001 bid, 2002 offered, 1,000 up. An institution wants to send a non-routable order to buy 10,000 for 2002. That order is also going to lock the way market, but it's marketable on this exchange, right? Now, again, they say, well, you shouldn't have sent a non-routable order. Well, if you know how electronic trading desks at banks operate, they don't like to pay exchanges for routing fees, so they send non-routable orders. The institution buys only 1,000, right? That's all there was there at 2002. And wants to pay 2002 for another 9,000. But he used the default order handling treatment and he was price slid to 2001 when he locked the away market. He wasn't allowed to post at 2002 after he cleaned out that 1,000. The trading firm, now let's say you're a HFT on the sidelines. There was a neutral market. There was no information at all. The trading firm sees the 1,000 trade at 2002, so he sees this 2-tick wide gap, which should be considered to jump in the middle, and he sees a new price slid bid for 9,000. So he sees the offer cleared out and 9,000 on the bid. Now you have an asymmetric market, 2 ticks wide, 10,000 on the bid. Could you have, I mean, if you understand how self-insurance works and the fact that this guy's just trying to flip out at the same price, you know, getting in front of that 10,000 bid on a 2-tick wide market is, you know, quite obvious condition to consider. So the trading firm then steps ahead of the institution by posting a hide and light hidden order. He locks the away market at 2002 ahead of the institutional order, and this complies with Rule 610. Meanwhile, a phantom order, a complete, you know, not unreal order, is displayed at 2001 on the price feed, and that looks like it's seemingly behind the institutional order. How'd you get there? Well, actually, the order was ahead of you, but the price feed told you the order was behind you. Okay? So if the institution was even smart enough to look into the screen and see what was going on, he would think, according to the, you know, the feed, that there was an order behind him, not ahead of him, because the hidden piece is ahead. Okay? So let's say the away market unlocks, and now the 2002 bid is now permissible to light up. Well, the hide and light order is rebooked. That's very important. The hide and light order isn't just to sit there and have its cake and eat its too. It has to be rebooked. Matter of fact, the phantom order that represented it is also pulled off the tape. So the hide and light order is rebooked as well as the institution's original order. They're both pulled off the book and then put at the same price, 2002. But in this particular exchange, they decided that they were going to do a swaparoo and put the hide and light order ahead of the institution. But if you think about, you know, think about the ethics here, that institution is the full information content, created the condition where the hide and light order could jump in, right? Is expecting, because he sent an aggressive order, he's expecting to set that new price, but this hide and light's going to go ahead of him. Well, guess what? It's not just one hide and light order that's going to go ahead of him. It's going to be the whole crowd of HFTs. Okay? If there's 6 guys, he could have, you know, a couple thousand shares or more ahead of him when the market finally lights. So he sits there, how am I getting done? You know, what's going on? What's going on? I can't get done. I can't get done. This market is so toxic. If you just used the right order types and understood the order handling treatment of that exchange, it wouldn't be toxic at all. Actually, what would you do? You'd jump in front of this guy. Okay. We're almost done, I guess. So in this particular example, I said that the lighting, that's important to understand. It's the lighting process when the market moves. Okay? Lighting unfairly advantages HFTs. The limit, and that's why I explained this all, but the exchange unfairly lit HFT-oriented orders ahead of orders commonly used by institutions. Because I'm running out of time here. Well, that's not all. That's just the only one that's public. Okay, there are actually 5 major classes of order, what I call order matching engine abuse. These types, queue jumping, the unfair order handling practices that permit HFTs to step ahead of investor orders. It's not just hide and light orders. That phenomenon applies to other order types. Okay, cannon fodder, and by the way, it's different on every exchange. Cannon fodder, the unfair rebooking and repositioning of investor orders that permit HFTs to flip out of toxic trades. Okay. You could debate every, you know, some of these and say that's okay or, you know, that was the intent. But when you look at the collective and you look at how each one operates on every exchange, you get a quite asymmetric market where the public customer is egregiously disadvantaged. Okay? So fish food. This is the one that really got me, actually. The unfair conversion of investor orders eligible for maker rebates into unfavorable executions incurring taker fees. What does that mean? Well, when you can get rebooked and have your orders slid around, you can basically be on the book, eligible for rebate, and then in some very strange, interesting situations, just be pulled off the book, drop back on like a market order, you pay the taker fee. And guess what? You executed it exactly the wrong time in that case. If anything was my bug, it was actually that one. Bait and switch, the unfair insertion of HFT intermediaries in between legitimate customer-customer matching. And catch me if you can, the unfair and discriminatory order handling of investor orders during sudden price movements. And I won't say much more now, but from my perspective, the article on me in front page of Wall Street Journal in September, that was just one of like 30 things on my list that irritated me. But again, that was one thing that the Wall Street Journal felt, and they had a hard time doing it, felt that they could explain to the investing public. So we're done with that. How much time do I have? We're done?
We're done 5 minutes.
Okay, so the industry forecast for 2003 in one sentence, things are changing and have been changing for at least 12 months. But most of these things here are not well understood by the greater investment community. So a lot of things that really irritated me that have been cleaned up probably will never come to light, but some will. That's it. Yep.
Just like to point out that Haim has a number of pieces posted on the TAB forum talking about these very topics. Would you suggest they all be read?
Yeah, well, actually I collected everything into a little book called The Problem of HFT. I was concerned that some of the arguments were being diluted, being spread across, and I have some new articles in there. So it basically gives the entire blueprint. If you want to do your homework, I gave you the Cliff Notes. Okay, it's 100 pages, but it's the Cliff Notes for this whole thing. There's going to be, I think, outside, I made these little bookmarks because I don't have books today, but there are bookmarks which are kind of glossy and nice. You can pick them up, and they'll tell you a little bit about the book, and also it'll point you to my webpage. Also, I think yesterday or the day before, I'm forgetting, the TAB forum did put a video up where I discussed
Yesterday.
Yesterday.
They put it up yesterday.
Yeah, I discussed this section here. So if you want to get my industry forecast, it's kind of embedded in that 12-minute video.
You want to take one question?
Sure.
Does anybody have one question? No? Oh, okay, right in the middle there.
You're focusing a lot on the passive strategies of HFT. My question is, how many strategies do you believe are strictly passive versus active or other types of strategies that are not based around that scalping as you described? And then,
well, I don't think of it as passive at all. I think that's what everyone's. I mean, what I think people don't understand is that these are aggressive, collision-oriented strategies. They're trying to come in and execute against someone at an effective mid. I mean, a lot of the trades they do, if you actually looked at it at the time of execution, it would look like they were giving up edge. They're really ahead of the crowd. They're not passively joining the crowd at all.
But is the purpose of this the primary rebate capture?
The purpose of it is to trade a significant amount of volume, and this is the mechanism by which it's done. It's not. Think about HFT. These strategies existed in future markets which don't have rebate capture. This is just a class of high frequency. It's aggressive. It's opportunistic. It is in effect predatory because it gets ahead of liens, right? It's not a passive market making strategy at all, and that's actually why these features should be quite useful for liquidity seekers to employ if they were well known.
Thank you.
Okay. Well, thank you very much.
Yeah. Thanks.